All right, today we are cracking open what is, no exaggeration, one of the most important investing books ever written, Benjamin Graham's The Intelligent Investor. So let's jump right into his incredible masterclass on value investing.
So right off the bat, Graham makes you face a really big choice. I mean, it is the foundation for everything else in the book. And it all boils down to one simple but powerful question.
Seriously, which one are you? Now you might think, of course, I'm an investor. But you gotta know, Graham's definitions are super specific, and they kind of challenge what a lot of people today call investing.
See the big difference here? The speculator, they are completely obsessed with the price of a stock. They're trying to guess which way it's going to move next. But the investor, they're obsessed with the value of the business itself. An investor puts in the work, they do the analysis, to make sure they're buying a piece of a real solid company, not just some lottery ticket.
Okay, so if you're not supposed to be hanging on the market's every word, how should you think about it? Well, this is where Graham gives us one of the best metaphors in the history of finance.
Let me introduce you to someone. This is your new business partner, Mr. Market. And he's a little emotional. See, every single day he shows up and offers to either buy your shares from you or sell you his. The thing is, the price he gives you is based completely on whatever mood he's in that day.
On his good days, Mr. Market is just on top of the world. He's totally euphoric, he thinks the future is amazing, and he will only sell you his shares for a sky-high price. You could say this is the market when it's feeling greedy.
But then, on other days, oh boy, he is a basket case. He's terrified, convinced everything is falling apart. On those days, he'll desperately try to sell you the exact same shares for pennies on the dollar. This is the market when it's afraid.
And here is the absolute key to the whole thing. Mr. Market is there to serve you, not to guide you. You don't have to listen to a word he says. Your job is to take advantage of his wild mood swings. You buy from him when he's panicking, and maybe you think about selling to him when he's feeling euphoric.
So how do you actually protect yourself from all this madness from Mr. Market and, from your own mistakes? Graham gives us a simple, brilliant tool that's really the heart of his entire philosophy.
First things first, you have to do your homework. You need to figure out a company's intrinsic value. Now, this has nothing to do with its stock price. This is what the business is actually worth, based on cold, hard facts. Things like its assets, its earnings, its financial health. So once you know what a company is really worth, you only pull the trigger and buy it when the market, usually because Mr. Market's having a bad day, offers it to you for a lot less. That gap, that discount between the real value and the price you pay, that is your margin of safety. It's your cushion. It's what protects you when you're wrong or just have bad luck.
Let's make this super simple. Say you do all your research and you figure out a company's stock is really worth about $100 a share. Well, an intelligent investor doesn't buy it at $95 or even $90. You wait. You wait for Mr. Market to get into one of his moods and offer it to you for, say, $65. That $35 difference, that's your margin of safety. It gives you a huge amount of room to be wrong and still not lose your shirt.
Okay, so we've got the mindset and we've got the tools. But Graham was a realist. He knew that not everyone has the same amount of time or energy to pour into this stuff. So he basically says investors fall into two different camps.
So you have to ask yourself, who are you? The defensive investor is all about avoiding big mistakes. They want something simple, kind of set it and forget it, usually using things like index funds for a nice, diverse portfolio that doesn't take much work. Then you've got the enterprising investor. This person is willing to put in the time and effort to hunt for those special, undervalued stocks, hoping to get better than average returns. Look, neither one is better than the other, but you have to be really honest with yourself about which one you are.
But really, all of these tools, all of these styles, they all lead up to what is probably Graham's most important lesson. Because for him, being a successful investor has very little to do with being a genius and everything to do with your character.
Just look at this list. You don't see anything about complex math or predicting the economy. No, it's about discipline to stick to your strategy. It's about patience, to wait for that right price. And it's about having the independence to think for yourself when the entire crowd is screaming at you to do the opposite. It really all comes down to controlling your emotions. And that's really the final takeaway here. This is not a get-rich-quick scheme. It is a get-rich-slowly-and-surely plan. The whole point is to build real, sustainable wealth over time by owning good businesses that you bought at a great price. So as we wrap this up, the question Graham leaves us with is the same one he asked at the very beginning, but now it carries so much more weight. Now that you understand the difference between price and value,
Now that you've met Mr. Market and you know about the margin of safety, what kind of investor will you choose to be?